So we have combined expense accounts. We're still on accrued expenses and prepaid expenses. So when you have combined expense accounts, it means you are using one ledger for two accounts. That is why we call it combined expense account. So the example made here is about rent and rates. So here it says sometimes the business may use one ledger account for two different but related expenses. Same principles are applied as those used for an account containing a single expense. It's still going to be the same thing. You credit your income statement, you debit your expense account. Yes. That's how it works. So here you're going to credit your income statement for the two accounts, which is rent and rates, and you debit the expense account for the amount involved for rent and rates. So here it said, Mary's financial year. Yes. It said Mary's financial year ends on 31st of March. She maintains a combined account for rent and rates. On 1 April 28, Mary had prepaid 1 month's rent for $300 and owed 2 months' rent for $1,000. So she's owing 2 months' rent for $1,000. That's a credit balance. That's on the credit side of the ledger, there's a 1,000 credit. Do you understand? Yes. That means we have the ledger now. The expense account. Yeah, we're going to have our opening balance on the credit side for 1,000, yes, and the opening balance on the debit side for 300. Do you get the point there?
This is prepaid.
Prepaid.
And 1,000 is old.
Old for the last 2 months. Yes. So that means she pays 500 per month for rent, and she pays 300 per month for rates. That is what it basically means. I think that is clear. Yeah. So now she said, during the year ended 31st March 29, Mary made the following payments by check. 1 of May, rent for 8 months to 30 September 28. So she paid rent for 8 months, 4,000. Rate for 13 months. So she paid rate for 1 year and 1 month. That's 3,900. So each month is 300. And for 1 December, rent from 5 months to 28 to 29 was 2,500. So she paid another rate for another 5 months, which is from December, January, February, March, April, May. Yes. For 5 months, 2,500. Now they said, write the ledger, write the rent and rates account in Mary's nominal ledger for the year ended 31st March 29. So before attempting an answer, the question is be helpful because we'll start the problems using the diagram. So for the rate starts from April to May. Yes, and we have from February to May.
Wait, that's the rate, right?
Yeah, we have April to May.
Oh, we have prepaid.
And February to May.
From April to May, yeah.
And February to May. So rate was paid $3,000 or $300 rate was prepaid. Yes or no? For 1 month.
Yes.
Which is for April. I think that is clear.
Wait, can you repeat it? You said prepaid for April is prepaid.
300, he said, yes, on 1st of April, Mary had prepaid 1 month's rate, which is $300.
That's April.
Yeah, April, $300. Yes. I think that is clear. Yes, yes. Then they said for the next 13 months, she paid the rates of 3,900. Yes. So from the rate starts from the 1st of June until next June. It was supposed to end in May, but it's going to end in June for 3,900. Yes. Do you get it?
So
from June to May is 3,900. 3,600.
What did it say from May to May?
From June to June, that is 13 months.
Oh, yes, yes.
But it has to read for a year. Yes. So for the first 12 months, it is 300 times 12. That is 3,600. Yes. So 300 goes as prepaid for the subsequent month. Yes. That is the point I'm making here. Is it clear? Yes. So from June to May is 3,900. I think it's clear. Yes, yes. Then for rent, that rate is done. For rent, she paid 4,000 for 8 months. 4,000 for 8 months. That will be until September. And another payment was made from 1st of December rent for 5 months, which is 2,500. That has to end in February.
Yes. Very nice.
Do you get it? So if you, for 4 months because the last month goes to the next financial year. So 2,000 will be recorded for this year. 500 goes to next month. I think it's clear.
Yes, yes.
Okay. Now, how do we prepare it? Look at the nominal ledger. The balance brought down. 300 was prepaid. That's why we have it on the debit side. Balance brought down. Then 1,000 was owed. Maybe it was only 1,000 rent. That's why we have balance brought down 1,000.
On the credit side. Yes.
On the credit side. Prepayment and accrued. Clear. Then the bank. They said she made payment for rent 1,000 or 4,000 on the 1st of May. The 4,000 is there. And she made rates for 3,900. And at the same time, she made another rent check payment for rent for 2,500. Yes. So that is all the payment she made as at that time. Then the balance for rent, which she was owing for the last year, is 1,000, which is there. Now, your income statement, I told you, when you are preparing an expense account, when you are preparing a ledger for the expense account, the debit side takes your expenses. The credit side goes with your income statement. Yes or no?
Yes, yes.
Now, on the income statement now, there's accrued expenses for 1,000. For rent, accrued rent for 1,000. That's rent payable. Yes or no? Yes. There's rent payable for 1,000. Then the income, rent paid, 6,000. Here they said they paid rent. The rent is 6,000.
They paid the first rent for 8 months, 4,000, and then 2,500.
500 for each month.
Yes, 500.
So for 12 months, it's going to be 6. It pays for 30 months.
Yes.
But it's 500 for each month. So 500 times 12 is 6,000. That's the rent in the income statement, 6,000.
Yes, yes.
For the rates, it's going to be for 12 months, not 13 months. That's 300 multiplied by 12, which is 3,600. So the total for rent and rates in the income statement is 9,600.
That's the total of.
Yeah, I think that is clear.
Yes.
So 9,600 plus 1,000 is what she's owing, which is 10,600. Do you get it?
Yes.
But on the debit side, the rent was paid for one. There's still another prepayment of 500. So, yes or no?
Yes.
So that's our balance carried down, which is 500 on the debit side. Because the debit side represents prepayment. Yes or no?
Yes,
so when you add all together, it gives you 11,200. 11,200 minus 10,600 gives you the 600 for rates. Is it clear now?
Yes, yes.
Rent was prepaid. Rate was owing. So when you make this account now, the difference between the debit side and the credit side is the balance carried down, which is for rates.
Balance brought down.
Balance carried down, which is rate. In April, it becomes balance brought down. Is it clear now?
Yes, yes.
Okay. So go to accrued income. So what is an accrued income? Accrued income is an income relating to a particular accounting period, which has been received at the end of the period. That's what we call accrued income. Do you get what it means here? It's an item. It means that someone has paid, you've received some benefits for service that belongs to that business, but you have not paid for them. Do you get what it means that another person receiving the benefit, that individual, your customer has received benefit from you, but he or she hasn't paid for it. But normally it's still going to pay. So this comes to your debt or your current assets.
Yes.
Did you get it?
Yes, yes.
Accrued income is a current asset because it is income receivable. Is it clear?
Yes.
All right. So they said the total of income accounts. Yeah. Okay. Let me just read it. They said when an item where an item of income is accrued, it means that another person receiving the benefit of service from the business during the accounting year has not paid for that benefit or service by the end of the period. So at the point of you preparing your financial statement, your income statement, the individual who has received a benefit The individual which the business has rendered a service has not paid for the service. That's why I call it accrued income. So it goes to our income, or it goes to our statement of financial position as income receivable. Is it clear?
Yes.
All right. So the totals of income account in the nominal ledger are transferred to the income statement at the end of the financial year. The matching principle is applied to income in the same way as it is to expenses, so that the amount transferred to the income statement represents the income for the accounting period covered by that statement. This means that any amount due but not received at the end of the financial year must be added to the amount received, and the total income related to that accounting period or year transferred to the income statement. So we have to use the matching concept. So any transactions that has been done that the payment has not been paid has to be recorded. But what do you do afterwards? You take it away from your statement of financial position.
Wait, you put in the statement of financial position
As income receivable.
current assets.
Current assets, yes.
Then how you can match it? Match it with the income statement.
The income, you record it in your income statement. Yes or no?
And statement of financial
Yeah, you record it in your income statement.
Yes.
But what it is income receivable, right?
Yes.
It's an income for the business.
Yes.
You add it, yes or no?
Yes, in the income statement.
But as soon as you have to, are you not going to take away when you have been getting your profit? Are you not going to take away expenses from the cost?
No.
How do you get your profit? Expenses from the cost.
Expenses from the cost, yeah.
Yes or no?
Yes.
So you would have gotten your profit. So whatever you get at that point in time is what you had to your assets.
Oh, yeah.
So one way or the other, you've added it and you've taken away your cost. So it's still reliable. You will receive that payment.
Yes, sir.
And it will be stated in your statement of financial position that certain individual is owing you.
And the income statement, both.
Yeah, it will be in the income statement.
Yes.
And you have to record it as a current asset, income receivable. It will be income receivable in your income statement.
Yes.
But when you prepare your statement of financial position, it is debtor.
The debit side.
Debtor. It's part of your current asset.
Yes, yes. Oh, yeah, the current.
Debtor, not debit or credit side.
Yes, yes.
Debtor.
And the income statement, it's dividend.
Yeah, it will be.
Yes.
In the income statement, it becomes income receivable.
And in the statement of financial position, it's debtor.
You know, in your income statement, income received is on the credit side.
In the credit side.
Yeah, expenses is on the debit side.
Oh, yeah. In the income statement, yeah. I think the statement of financial position, you record it as current asset.
And debtor. Yeah.
Yes.
I think it's clear.
Yes.
So, the income account will now show a balance equal to the amount not yet received. To complete the double entry, the balance is brought down on the debit side of the ledger account as the balance represents an amount owing to the business due to be received in the near future. It will be included in your current asset in the statement of financial position. That's it. I think it's clear now.
Yes.
So during the year, you credit the income statement and debit the cash book with the amount received. You know, you would have received certain amount, not all. You get what I'm saying here? Your income statement will be credited with that amount. And your cash book, you debit your cash book because you receive cash. Any amount you receive any amount is debited in the cash book. Any income is debited in the cash book. Any expenses that you paid for is credited in the cash book. Yes, so now in your income, for your income, accrued income, you credit the income account and you debit the cash account.
In the cash book.
In the cash book, yeah.
You credit what?
The income account. You credit the income account.
Yes, and debit
the cash book account. Yes. I think it's clear.
Yes.
So at the end of the year, you know, that is during the year.
Yes.
At the end of the year that you are preparing your statement of financial position, where you have to separate. Yes.
Yes, I get it now, yeah.
Yeah, where you have to separate assets, liabilities, and prepare everything. That is done at the end of the year. You credit the income account still. Now you take the amount to the debit side as your balance carried down. So the balance carried down becomes what goes to your statement of financial position. Do you get it? During the year, because the transaction is still going on, transactions are still going on, you record it on the credit side because it's income.
And in the ledger.
Yeah, it's income.
You credit in the ledger.
In the income, yeah, your ledger account for accrued income, you credit it. In your ledger, you credit it. You credit the amount,
Yes.
the value of whatever it is,
Yes.
and you debit the income statement.
Yes, I get that.
But if it is expenses, you credit the income, you debit the income statement, you credit the expense account. Clear?
Yes, I get that.
Okay. So here we have a question. It said, Salman started the business on 1st of April 27. On that date, he also agreed to act as an agent for Kohli and company. Salman was to be paid a commission for 6 months in arrears on all goods sold for Kohli and company. In arrears, that means they will pay Salman after the transaction is done. You get it? That's in arrears. So commission for of 120 was received by direct debit on 1st of October, and 135 was received by direct debit on 2nd of April. So there were two payments there, 125, 120 and 135, which is 255 was received. Yes or no?
Yes.
That's income received. So now they said, write up a commission receivable account. Now we want to prepare a commission receivable account for Salva. That's a nominal ledger. So how do you prepare that? In the nominal ledger, the total of the income statement, because it's commission receivable, what did I tell you? You debit the income statement.
Yes.
And you credit the giver, which is the bank. Yes or no?
Yes.
So income statement, we have 225, which is 120 plus 135.
Yes.
I think that is clear.
Yeah.
So on the credit side of your commission receivable account, you write the transaction, which are bank 120, balance carried down 135. Clear?
Yes.
So now the extract, we don't have gross profit. You leave the gross profit. The total is what goes to as income commission receivable, 255. Yes or no?
Yes.
But remember that 135 was balance carried down. Yes or no?
Yes.
So the 135 becomes what? Accrued income.
Yes. Income.
You know, they told Salma that they're going to pay Salma in arrears. 125 was paid. Then afterwards, 135 was to be paid.
Yes. Yes.
But 135 has not been paid yet. So 135 becomes accrued income because that transaction is done. Salma has carried out that transaction, but still waiting for the payment to be made. So the three accounts now are what? We open a ledger account, which is a commission receivable account. For the commission receivable account, on the debit side, you have your income statement, totaling the amount of job Salma has done, which is 255.
Yes.
On the credit side, the two were not paid during the year. One was paid during the year 27, which is bank 120. The second one is about to be paid. It becomes our balance carried down. So the difference between the income statement tells us about all our transactions during the year.
Yes.
When we have to prepare our statement of financial position, we take whatever we've been paid. Now we've been paid 120. So in our cash book, as we are recording income statement in the commission receivable account, we debit the income statement with 255. In our cash book, we receive 120. So we debit the cash book. We debit on the cash book account. The debit side, we receive bank. The details will be bank 120.
Yes. Yes.
Do you understand? So you debit 120 in your bank account, in your bank column in the cash book.
Yes.
That is done. But 135 is still left to be paid. So 135 is going to your income statement. So when it gets to your income statement, it becomes an extract of the income statement. So for the extract of the income statement, you have your gross profit, but we don't have gross profit because this is a service business. A service business do not trade. So most of the time we don't have gross profit for service business. We only have net profit. Are you with me?
Yes.
So because we don't have gross profit, we leave it. Our income statement, the value of our income statement is what? 255, which was for commission receivable. It's going to be on the credit side of your profit and loss account in the income statement, the credit side, because it's commission receivable. Expenses is always on the debit side. So if it was commission payable, it will be on the debit side of your income statement, and it will be liability, current liability. But here we're talking about accrued income, payments that we've done the service, we are expecting the payment. 120 was paid, 135 is still being owed. So in our income statement, I told you it becomes a commission receivable on the credit side of our income statement for the total amount of what we have done. 255. But how are we going to be able to state what they are owing us? That will be in the statement of financial position. In your statement of financial position, what will you do? You record accrued income of the amount you carry down, which is 135. Then it shows that the amount of money you pay, your account has balance. So it is reliable because you matched the expenses with the income.
Yes, sir.
Your income statement is 255. But it's not going to be 250. 255 is your income statement.
Yes, sir.
But there's 135, which is stated as accrued income.
Yes, accrued.
So with that, you'll be able to balance. Is it clear now?
Yes, yes.
Any question?
But in the statement of financial position, you said that 135 will be accrued income.
Accrued income, yes. Current assets.
You're not going to you're not going to state 120. The 120.
120 is done. It's in your cash book.
It's in the cash book.
Yes.
You don't need to do it in the statement of financial position.
No. In your cash book. Your cash book is the total of what you've made.
Oh, yeah. You've got it. You already got it. Yeah.
You've made the payment. The cash book talks about what has been paid.
Yes, I get it now.
You note that in your cash book, the total cash at hand, the total cash at bank would have been recorded in your statement of financial position.
Mm-hmm.
So if you are recording it again, you are posting twice. You overstate it.
Yes.
Get the point? Your cash book has the cash column and the bank column. The difference between the debit side and the credit side is your cash. The difference between the debit side of your bank column and the credit side of your bank column is your bank.
Yes.
Get it this way. When we have our cash book, we have at the end of the preparation of the cash book, we have the debit side of our cash book for bank, the debit side of our cash book for cash, the debit side of our cash book, or the credit side of our cash book for bank, the credit side of our cash book for bank. The difference between the debit side of the cash book and the credit side of the cash book is our cash at hand. It goes to your statement of financial position. The difference between the debit side of the bank column and the credit side of the bank column is our cash at bank. It goes to the bank, to the statement of financial position as cash at bank. So if you now record 255 again, you are recording twice. So the only thing you have to record now is 135, which is the amount owed.
Yeah.
Is it clear now?
Yes.
Okay. So we'll go to prepaid income. Sorry, I need to. Okay, so. You have to get the income statement and debit the cash flow with the amount received. You know, you would have received certain amount, not all. Not in a year. You get the So for prepaid income, they said, where an item of income, where an item of income is prepaid, it means that a person had paid for a benefit or service from the business, but that this has not been provided by the business at the end of the financial year. So at the end of the financial year, some customers have paid you, but you've not carried out that job that you are supposed to give to them. You've not done what you've not given them the service they requested for. Maybe because it is not time yet to give it to them, but they've paid you. That is prepaid income. You receive the money. So once again, the matching principle must be applied. The matching principle must be applied so that the amount transferred to the income statement represents the income for the accounting period covered by that statement. Any amount received during the financial year relating to a future accounting period must be deducted from the amount received so that only the income relating to the account period is transferred to the income statement. So if you have received 5,000 and you have only worked for 3,500. So you only record 3,500 as your income receivable. So you'll be able to transfer 1,500 to the statement of financial position as current liability. Yes. Do you get the point I'm making?
Yes.
For accrued income. What? Accrued income means an individual or customer has paid you. Okay, so if this customer has paid you, he has paid you for certain services that you have not recorded for the year. You have not done the job for the year, but you have been paid for that job. That is why we call it accrued income. Now, how do you prepare your account for such amount?
Prepaid.
Prepaid income, sorry. I said accrued, right? So I wanted to say prepaid income. Prepaid income means an individual or a business has paid you for certain amount of money, for certain businesses to be done, or for certain services to be rendered to, but you've not carried out the job or the function, but you've gotten the payment. That's why it is prepaid income. So this amount you have received for a service that you have not rendered during the accounting year. So how do you prepare it when you are preparing your income statement? When you are preparing your income statement, that amount that you have received, the total amount you have received, you deduct the amount of money or the worth of job you've done from it. So that means if you have, for example, you have a prepaid income of 5,000 on commission, maybe a transaction for 5,000. So the transaction is supposed to be 5,000, but maybe you have to do 4 advertisements. Let's assume that you have to do 4 advertisements for a company for $5,000.
Yes.
And you have done only 3 advertisements. So out of the 3 advertisements you've done, you've been paid 3,500. So you've collected 5,000 for advertisements. The advertisement is supposed to be 4 adverts.
Yes.
So out of the 4 adverts, you've done 3 adverts, but you've been paid the total amount. That's why it is prepaid. So you've carried out 3 adverts, remaining 1 advert. So let's assume the cost of 1 advert is 1,500. So when you are preparing your income statement, you cannot record what you have not worked for in your income statement. That means you have to apply the matching concept. The income for this year must go with the expenses for this year. So the profit for this year must be taken away from the cost of this year. So there are some transactions that you have not done. So that should be recorded in your statement of financial position as prepaid income. Do you understand? So it becomes a current liability in your statement of financial position. So the first thing you have to do is this. As soon as 4 adverts was done, the value of 4 adverts is 3,500. So 3,500 is what you record in your profit and loss account as income received. That is clear. So because of the matching principle concept, you do that. So what next do you do? Here they said, once again, the matching principle must be applied, which we talked about, so that the amount transferred in the income statement represents the income for the accounting period covered by that statement. Any amount received during the financial year related to a future accounting period must be deducted from the amount received, so that only the income related to the accounting period is transferred to the income statement. So if you've received 5,000, which is prepayment, and you've worked for 3,500, you take 3,500 from 5,000. So you are transferring 3,500 to your income statement and your cash account. It will be debited in your cash account. Clear?
Yes, yes.
And your statement of financial position will have 1,500, which is it's a liability to you because you are owing a certain customer. That you are owing that customer, not because you are owing him cash or her cash, because you are still owing that customer a service that has not been rendered. Do you get it?
Yes.
So the income account will now show a balance equal to the amount received in advance. To complete the double entry, the balance is brought down on the credit side of the ledger account. This balance can be included as a current liability in the statement of financial position. So the income statement, you have your 5,000 for the job. Yes or no?
Yes, yes.
Your ledger will have 3,500. The credit side of your ledger will have 3,500. And the debit side will have income statement for 1,500. which will be transferred to your statement of financial position as current liability. Is it clear or not? I will repeat. We have 5,000. We talked about it.
Yes.
Out of the 5,000, you've carried out the job of 3,500. So the 3,500 in your income account, what do you do with your income account? The amount you have received, you balance bill down. It becomes your balance bill down. 1,500 is your balance carried down. Yes or no? But normally you have 5,000, which was received from the beginning. That's the balance bill down, which is your opening balance, which you received. Yes or no?
Yes.
So here they said the income account will now show a balance equal to the amount received in advance. To complete the double entry, the balance is brought down on the credit side of the ledger. You received an amount of money that you have not serviced. You've not rendered the service. You received it. Yes or no? Because you received that amount, which is prepayment, that has to be, the job has to be done. Are you going to credit, are you going to record this on the debit side or the credit side? On the credit side, because it is the money you've received it, but you've not carried out the job. It's just like you are owing the customer. You are owing, just like you are owing the supplier. When you are owing a supplier, it will be on the credit side of your ledger because it is amount payable. Yes or no? Yes, so that is why it's going to be the balance brought down on the credit side as 5,000. Yes or no? Yes. So your income statement is how much? 3,500 on the debit side. On the income statement. The income statement will be on the debit side now because the income statement will receive is done the job 3,500. So 3,500 in your income statement is still going to be recorded in your cash book as 3,500. The same thing. Yes. Done, right? Now 1,500 is left. The 1,500 will be the difference between your income statement and your balance, your balance brought down of 5,000. Yes. So at this on the credit side, you're going to have your balance carried down again. You're going to have your balance brought down, which is the amount of money you've received on the credit side because you have not done the job. Yes. And you're still going to have your balance carried down, which will be the difference between the balance brought down of 5,000 and the income statement of 3,500 on advertisement. So the balance carried down will be 1,500. So the balance carried down of 1,500 on the credit side comes to the debit side for the new accounting year as balance brought down 1,500. So that 1,500 is what you record in your statement of financial position. Is it clear? So let's look at what we have here. Yeah, let's just go to the work. They said someone started the business on April 1, 27. Someone rented premises until 1 July 27. When he purchased premises on that date, he rented out part of his premises to another trader at an annual rent of $1,000. So there's rent receivable and rent payable. So part of the premises has been rented out, which Sama will be getting certain amount of money from 1,000. Yes. Now, payable quarterly in advance. Payable quarterly in advance. So that means you pay in advance. Mm-hmm. That's prepaid. Yes. Prepaid rent. Did you get it? Yes. Quarterly. That's 1/4. Yes. Okay. So they said the tenant paid rent of $250 by direct debit on 1st of July, on December, and so the tenant paid $250, $250. That's $1,250, the total. Yes or no? That's $1,250. Yes, $1,250. Good. They said write off the rent receivable account in Salman's ledger for the year ended 31st of March 28. Until June 28, Salman has received 1,000. Between June to
the nominal ledger.
In the nominal ledger.
So we debit the income statement by 1,000.
1,000.
Yes. And then
the rent receivable account.
The rent receivable account.
The income statement will be, it's not going to be 1,000.
Yes, and 1,000 debited the nominal ledger.
1,000 is paid.
Yes, it's paid.
Okay. The payment was 250, 250, 250, 250, yes, which was 1,000. So that's for 4 months. Yes. But it's quarterly. It's 1/4 multiplied by 12, which is every 3 months. Mm-hmm. Did you get it? Yes. So every 3 months, it represents $250. Yes or no? Yes. So 250 multiplied by 3 is 750. Yes. So the rent paid in the income statement will be 750. which goes for the first 9 months. Do you get it or not?
I think it's the financial year will be a year.
Yeah, it's a year.
But they said that 1,000 a year. So it's the income statement will be 1,000.
It can't be 1,000.
Because it's, he paid in advance.
In advance.
1,250.
It pays 1,000. It's 1,000.
Payable quarter in advance.
Yeah, it's 1,000. 1, 2, 3, 4. It's 1,000. 1, 2, 3, 4. Is 250 in July, October, December, and March.
Mm.
Did you see it? It's 1,000.
Yes, 1, 2. It's 1,000.
It's 1,000. So if he has paid 1,000, how do you record it? You record it as 1 quarter, right? It's a quarterly.
Yes.
Every 3 months. The first 3 months, 250. The second 3 months, 250. The third 3 months, 250. 750.
So
remember, we said the matching concept. Yes. You only match what you have, the income with the expenses, the cost from the profit.
Yes.
So 1,000 has been received because it is prepaid in advance. But the tenant has only used 9 months, which represents 750. Yes or no? Yes, yes. The total paid on the debit side, because you receive these checks.
Yes, yes.
So it has to be recorded. The 4 checks has to be recorded with their dates, which is total 1,000. But your income statement is where we are particular at. We have on the debit side, we have our income statement and our statement of financial position. Both will tell us, the income statement will tell us about our income. The financial statement is going to tell us, the income statement is going to tell us about our income and our expenses. Yes. The financial statement is going to tell us about our assets and liability. Yes. So now we have 1,000. The 1,000 will be split into income or expenditure, yes. But because we are talking about income here, it's going to be split into income and liability. Yes. Income and what? Liability, because it's a prepayment. Yes, yes. So how much do we receive? We received 1,000.
750.
750 will be in our income statement, yes. And in the cash book.
Yeah, and 250 will be in the liability.
Statement of financial position as
liability.
Liability.
As
accrued rent. Prepaid rent.
Prepaid rent, yeah.
Is it clear?
Yes.
So you call it prepaid rent or income rent, income prepaid.
Income prepaid.
Yeah, it's the same as prepaid rent. It's income.
Or prepaid income, is it the same?
Yeah, it's the same. Is it clear?
Yes.
All right. So we go to opening balances on income accounts. Are you there? Yes. I think it's clear now.
It's clear.
So the opening balances on income accounts. Yeah, in the second and subsequent years of trading, a business may have opening balances on income accounts as well as opening balances on expense accounts. They must be considered when these must be considered when calculating the income related to the particular financial year for which the accounts are prepared. Summer financial year ends on 31st of March. He acts as an agent for Coley and the rest, and so on. On 1st of April 28, the commission receivable account in Summer's nominal ledger shows a debit balance of 135. So that is service, yeah, service business. That's an opening, a balance brought down of 135 on the debit side. That's an opening balance. Clear?
Yes.
During the year, 31st of March 29, he received direct debit for commission as follows: 135 and 145. At March 31, commission due but not yet received this amount amounted to 156. Not yet received. Accrued income. Thank you. So write up the commission receivable account in Summer's ledger. So how do we write that? So we go to commission receivable account. We have our balance brought down on the debit side for 135. Yes or no? Yes. Okay. Then in the income statement, what happens to our income? So for the bank, he received 135. He received 145. Yes, he received 135 and 145. Yet to receive 156. Is yet to receive 156.
Yes.
Yes or no?
Received 135 and 145. Yeah. And yet to receive amount of 156.
156. So All these, so the balance carried down will be 156. Yes or
For
no?
the next year.
Now your income statement. Your income statement, because these are payments, right?
Yes.
Your income statement will be 135 plus 145. Yes or no?
Yes.
Okay, so your income statement will carry out 301. So we add it up with your opening balance of 135.
Yes, sir.
Yes or no?
Yes.
Then the difference between your debit side and your credit side is your balance brought down for April next year. Do you get it or not?
Yes, sir. Can you repeat this to the last part?
Yeah.
You said
There's an opening balance of 135. Yes or no?
yes, opening balance.
That's a debit balance, isn't it?
Yes.
Then
So he paid.
they paid in. They paid Salma.
Yes, he paid 135.
135. Yeah, opening balance. That's the opening balance.
Yes.
Then Salma received 135. It received 145, yet to receive 156. All these things have to be calculated together.
So you have to, you eliminate the 135. Because
you add it.
You add it.
It's part of your, is it not part of your commission receivable account?
Yes. It is, yeah.
The balance brought down is an amount that Salma collected for the job Salma has done. Do you get it?
Yes, we pay.
No, for 135. It's an opening balance, 135 check.
Oh, yeah. And then you add that.
If Salma has not done the job, listen, if Salma has not done the job, it will be on the debit side, it will be on the credit side. So this amount was due for Salma that has been paid now.
This is again. No.
Aha. So your income statement calculates 135 and 145. But you have to add the amount of money you received, which is part of your commission receivable.
Yes, yes.
Together, it becomes 436. So the difference between this and the total is 156. That is yet to be paid.
Yes, yes, yes. So
156 goes to your income statement, to your income statement. So 156, yes, it goes to your statement of financial position.
156, yes.
Yeah, it goes to your statement of financial position.
As a current asset. Yes,
current assets.
Yes.
As income rent receivable.
Or income receivable.
Or income rent receivable. Rent receivable.
It's not rent, I think so. It's rent. It's
commission receivable, sorry. Commission receivable, yes. Is it clear?
Yes, yes. Or accrued commission. No.
Income.
Accrued income.
Accrued income, yes. Accrued income is still an asset. It's a current asset.
Yes, yes.
Is it clear?
Yes.
All right. So here they said, summer financial year ends on 31st of March. He rents part of his premises to another trader. I think we did this. Hold on, please. So the note is this. In summary, when you have prepayment account, when we have prepayment, we're going to have an income. We're going to have an income and we're going to have liability. And when we have accrued, we're going to have expenses and assets. That's it. So you can do those questions after now. Let's go to economics.